At Insightful Value, we scan the global market for quality companies trading at surprising discounts. Nestlé, a consumer giant, has caught our attention. Yes, the stock price is lagging, but is the market missing something, or are there deeper cracks behind this decline? This review is for informational and educational purposes only and does not constitute financial advice. If you're into smart investing, subscribe to the channel and give this video a thumbs up. Nestlé is one of the most recognized food and beverage companies on the planet, with brands in virtually every aisle of your supermarket: Nescafé, Kit Kat, Purina, Maggi, Gerber, and many more. The company operates in over 180 countries and spans categories like coffee, dairy, pet care, infant nutrition, water, and plant-based foods. With such global reach, you'd expect this stock to be a solid defensive play. And yet, it's been underperforming. So what's going on? In the first half of 2025, Nestlé reported sluggish growth, mainly due to weak volumes. Organic sales grew just 1.5%, with real internal growth negative, meaning price hikes are propping up the numbers while actual product demand is declining. The company blamed weak demand in pet care and North America, and even in coffee, their crown jewel, sales momentum has been uneven. Earnings per share dropped compared to last year, and investors are starting to question whether the company can regain its margin strength. Nestlé's operating margin fell to around 15%, down from pre-2022 levels, squeezed by higher input costs and lower volumes. Free cash flow also came in weaker than expected. Despite this, Nestlé maintained its dividend growth streak, now yielding just over 3%, which is high by Swiss standards and backed by a solid payout ratio. From a value perspective, this is where it gets interesting. Nestlé is trading at its lowest valuation relative to earnings in nearly a decade. The price-to-earnings ratio is now around 17, which is significantly lower than its historical average. This discount reflects concerns about growth and margin recovery, but could also offer upside if those concerns ease. Why might investors look at Nestlé right now? For one, it's a global brand powerhouse with a diversified product mix and defensive qualities. If inflation stabilizes and volumes recover, margins could bounce back. The company is also actively reshaping its portfolio, selling underperforming brands and investing in high-growth areas like health science and premium pet care. On the other hand, why might you hesitate? Nestlé's innovation pipeline has underwhelmed lately, and it's not clear if management can reignite consumer demand. Currency headwinds, especially from emerging markets, and increasing regulation on sugar and ultra-processed foods add to the risk profile. Plus, volume declines could continue if consumers shift to private labels. Dividend-wise, Nestlé has delivered consistent annual increases for decades. The payout is safe for now, but future growth might slow if earnings stay flat. Still, this steady stream of income adds a cushion for long-term holders. Could the stock price recover soon? That depends on cost control, demand stabilization, and investor confidence in Nestlé's new strategic initiatives. If the company can show even modest volume recovery with stable margins, the re-rating could be swift. Until then, it's a quality name trading at a discount, with some baggage. At Insightful Value, we decode complex financials and spotlight undervalued companies like Nestlé. Whether you're a long-term investor or just curious about opportunities others overlook, our research is built to inform and empower without the jargon. You can find more on Nestlé and other undervalued companies at insightfulvalue.com. Don't forget to like the video, subscribe to the channel, and check out our research at insightfulvalue.com.